Introduction. Term structure of interest rate. In order to simplify the process of explaining the concept, the interest rates considered are assumed to be constant for the future period, such as the one considered while determining the interest rate. This assumption is actually in contrast with the reality where the interest rate fluctuates owing to the inflationary expectations of the future. After studying this module, you shall be able to understand the process of bond pricing, understand the term structure of interest rates, calculate the relationship between yield and rate of interest, know about different theories of interest rate structure. Spot rates, bond pricing and the yield curve. Spot rates. The price or rate of buying or selling a commodity, security or currency for settlement on the spot date is known as the spot price or spot rate. In other words, spot rate is the current exchange rate of a commodity currency. The bootstrapping method is used to estimate spot rates for bonds in the market, plotting a spot curve employing the current market price or spot price of the fixed income securities trading in the market. Bond pricing. In simple words, it is a price paid by a person to buy a bond. Alternatively, present value of the expected cash flows of a bond is termed as bond pricing. And the future value of a bond is generally higher than its present value owing to the fact that rupees 100 has a higher value today as compared to its value in future. Next, yield to maturity. It is defined as the single interest rate at which the market price of a bond is equal to the sum of present value of its coupon and its principal payments. For example, for 1 year loan whose present value is $100, its future value is $120. The YTM can be calculated similar to the calculation of simple interest rate R1. That is, R1 is equal to $100 minus $120 upon $100, which is equal to 20 upon 100, which is equal to 0.20 or 20%. The format for the calculation of YTM changes in the case of coupon bond. Coupon bond is a bond where a fixed interest payment, coupon payment, is received every year till maturity year by the investor when the specified face value of the bond is also repaid back to the investor. It becomes present value is equal to C upon 1 plus R plus C upon 1 plus R raised to the power 2 plus C 1 upon R raised to the power 3 plus C upon 1 plus R raised to the power 4 till plus F upon 1 plus R raised to the power T, where C is equal to price of coupon bond or yearly coupon payment, F is equal to face or future value, PV is equal to present value, T years to maturity, R is equal to rate of interest or YTM. However, since YTM is difficult to calculate, the approximate yield to maturity AYTM was developed. With R is equal to F minus PV upon T plus C whole upon F plus PV upon 2. Next, term structure of interest rate. The relationship that exists between maturity and annualized yield of the security is known as term structure of interest rates or yield curve. The yield curve assists in predicting expected future short-term interest rates. The shape of the yield curve varies from upward sloping to flat to inverted or downward sloping. The upward sloping yield curve is obtained when the short-term yields are lower than the long-term yields. This positive yield curve indicates at the strong economic growth expectations of the investors, followed by the expectation of higher inflation in the future driving up the interest rates. It also indicates at the higher expectation of rate of return by investors for undertaking a higher risk in long-term investment. The downward sloping yield curve also known as inverted or negative yield curve, is obtained when short-term yields are higher than the long-term yields. The economists interpret it as a sign of stunted economic growth with the future inflation rates expected to be lower, driving the interest rates downhill with them. On the other hand, the flat yield curve denotes little or insignificant variation between long and short-term yield rates, signifying the uncertain expectation of the investors regarding future economic growth and the inflation. These theories enlightened about three facts of the yield curve. That is, first, there is a tendency of the interest rates even for securities of different maturities to move together over time. Second, the low short-term interest rates leads to an upward slope of the yield curve, while high short-term interest rates lead to downward sloping yield curve. Third, generally and typically, the yield curves are upward sloping. Next, pure expectations theory. This theory states that at any given point in time, the market's current expectation of future short-term interest rate defines the shape of the yield curve. Thus, an investor planning the purchase of security must decide between long-term or short-term securities, as it can invest only in either of the two. For instance, if the investor has an investment horizon of 6 years, then the investment can either be made currently in 6-year bond, earning current or spot yield each year, or 6 successive separate investments can be made every year in 1-year bonds, where the interest rate of only 1 year is known and the rest 5 years rate forms the expected rates. The expectation of higher interest rates in future will direct the investor towards the purchase of short-term securities, enabling them to reinvest their funds at a higher interest rate bearing higher yields. Consequently, the yield curve will slope upwards, with the investors preferring short-term securities in place of a long-term security providing current or spot yield. The prices of the short-term securities will scale up owing to its strong demand, leading to the decline in its yield. Similarly, the diminished demand for long-term security will shrink its price and increase its annualized yield. Likewise, the borrowers, also expecting a rise in their capital cost, riding on the expectation of higher interest rate in future, will prefer to issue long-term security at a current lower rate of interest than short-term security. While the price of the long-term securities would experience a decline owing to the large supply of long-term securities issued, leading to a rise in its yield, the price of short-term securities would increase due to the shortage in the supply of short-term securities issued, leading to a decline in its yield. Next, estimation of the forward rate. Illustration. As per the pure expectation theory, the return to hold a 2-year bond to maturity must be equal to investment in 2 successive 1-year bonds. That is, 1 plus TR2 raised to the power 2 is equal to 1 plus TR1 into 1 plus T plus 1 R1, equation 1, where TR2 is equal to annualized interest rate of a 2-year security as of time t, which is currently known. TR1 is equal to annualized interest rate of a 1-year security as of time t, which is currently known. T plus 1 R1 is equal to interest rate of a 1-year security as of time t plus 1, which is not known and thus forecasted. The current purchase of a 2-year security giving compounded yield to the investor, also known as spot yield, is represented by the left hand side of the equation. Therefore, casted compounded yield obtained from a sum of spot yield of 1-year security and reinvestment of those proceeds into successive 1-year security formulates the right hand side of the equation. Rearranging equation 1, we get 1 plus T plus 1 R1 is equal to 1 plus T R2 whole square upon 1 plus T R1. T plus 1 R1 is equal to 1 plus T R2 whole square upon 1 plus T R1 minus 1, equation 2, where T plus 1 R1 that represents market's forecast of the future interest rates known as forward rate. As the term structure of interest rate represents the relationship between different maturities and yields, the interest rate changes in response to the change in maturity of security. Subsequently, with the change in their maturities and interest rates, their forward rates also changes correspondingly, which can be determined by expanding equation 1. Thus, the following equation, extended version of equation 1, represents the return to holding a 3-year bond to maturity as per the pure expectation theory. 1 plus T R3 raised to the power 3 is equal to 1 plus T R1 into 1 plus T plus 1 R1 into 1 plus T plus 2 R1, equation 3, where T R3 is equal to annualized interest rate of a 3-year security as of time t, which is currently known. T plus 2 R1 is equal to interest rate of a 1-year security as of time t plus 2, which is not known and thus forecasted. Similarly, derived its forward rate as of time t plus 2 will be T plus 1 R2 is equal to 1 plus T R3 raised to the power 3 upon 1 plus T R1 into T plus 1 R1 minus 1. Next, summarized relationship table. On the above line, the relationship between maturity and yields can be summarized conditional on the fact that the term structure of interest rate is solely influenced by expectations of future interest rates. From the following table, when T plus 1 R1 is greater than T R1, then expectation of future interest rate is higher than spot rate and structure of yield curve is rising. Next, T plus 1 R1 is equal to T R1, then it will be same as spot rate. The structure of yield curve will be flat. Next, when T plus 1 R1 is less than T R1, then lower than spot rate, structure of yield curve will be inverted. This theory thereby explains the persistent movement of interest rates of securities having different maturities owing to the fact that the longer rates and the average of the change in short-term interest rates are equal, moving together in same direction. It also explains the inverse relationship between the yield curve and the interest rates, that is, yield curve sloping upwards when the interest rates are low and inverted yield curve when the short-term interest rates are high. Next, liquidity premium theory. This theory advocates the compensation in the form of premium for holding long-term LT securities to the investors. The premium compensates for the lower liquidity and higher uncertainty attached to the security that rises with the increase in maturity of the asset. The investors prefer short-term securities in comparison to long-term securities as ST securities offer higher liquidity. Liquidity means easy conversion of security into cash without loss of value and reduced risk of capital loss, since the price fluctuation of ST securities with every change in interest rate is smaller. On the other hand, the LT securities are more sensitive to interest rate movements, leading to higher risk of capital losses, for which the investor must be compensated via liquidity premium. The liquidity premium theory for a 2-year security can be expressed as 1 plus T R2 raised to the power 2 is equal to 1 plus T R1 into 1 plus T plus 1 R1 plus L2, where L2 represents the liquidity premium on a 2-year security. Further, this liquidity premium appreciates with the increase in maturity of the asset. This relationship between liquidity premium and term to maturity can be expressed as shown in the text. Hence, if according to this theory, if there is a significant influence of liquidity on the yield curve, then the forward rate estimated by the pure expectation theory overestimates the market's expectation of future interest rate. This can be illustrated with the help of an example and following graphs. Example. Estimate the forward rate of the security if its current annualized rate of interest for 2 years is given as 10% and for 1 year is given as 8%. The liquidity premium on a 2-year security is 0.5%. Solution. The equality specified by pure expectation theory for a 2-year security will be given by the equation 1 plus TR2 raised to the power 2 is equal to 1 plus TR1 into 1 plus T plus 1 R1 plus L2, where TR2 is equal to 10%, TR1 is equal to 8% and L2 is equal to 0.5%. Forward rate, that is T plus 1 R1 is equal to 1 plus T R2 whole square upon 1 plus T R1 minus 1 minus L2 upon 1 plus T R1. T plus 1 R1 is equal to 1 plus 0.10 whole square upon 1 plus 0.08 minus 1 minus 0.005 upon 1 plus 0.08, which is equal to 11.574%. The forward rate obtained by liquidity premium theory LPT is definitely lower than that obtained from pure expectation theory, which was 12.037%. Hence, accordingly, the yield curve adhering to LPT will also needs to be adjusted at a lower yield curve than that obtained from PET, owing to the presence of liquidity premium that was missing in PET. As you can see in the figure, shows the impact of liquidity on the yield curve under 3 different versions. Scenario 1, market expects stable interest rates. Scenario 2, market expects an increase in interest rate. And last, scenario 3, market expects a reduction in interest rates. This liquidity premium theory is the single theory which explains and supports all the 3 facts of the yield curve. Next, market segmentation theory. The market segmentation theory states that it is the need of the market participants, borrowers and investors and not the expectation of future interest rate that determines their choices of securities with different maturities. That is, choice between long-term and short-term maturities. Accordingly, while banks having short-term liabilities would preferably invest into short-term securities, the pension funds and life insurance companies would preferably favor long-term investments consistent with long-term nature of their liabilities. This way, the market gets segmented with market participants restricting to the respective maturity market that attends to their separate needs. For instance, assuming that the market is segmented with investors having the funds for ST investments only, whereas the borrowers are looking forward to long-term borrowings only issuing LT securities. Correspondingly, the demand for short-term securities would increase the price of the short-term securities, reducing the yield on them, whereas the supply of long-term securities will decrease the price of LT securities, increasing the yield on them. Cumulatively, the aggregate result would be an upward sloping yield curve. On the other hand, the reversal of the scenario with investors preferring LT investments only and borrowers desiring ST funds issuing ST securities will result in a downward sloping yield curve. The higher demand for LT securities would increase the price and decrease the yield on the LT security, and the higher supply of ST securities will decrease the price and increase the yield on ST security as per the market segmentation theory. However, this difference in the yields of LT and ST securities can be ironed out, or in other words, yields of LT and ST securities could be made more similar if the investors' demand and borrowers' supply of securities of different maturities can be balanced. As follows, this theory contradicts one assumption of pure expectations theory that the maturity markets are perfect. The market segmentation theory confers only partial and not the sole explanation for the shape of the yield curve. Subsequently, preferred habitat theory evolved that proposed a compromising explanation for the term structure of interest rate, recognizing the influence of natural preference for a particular maturity market of the market participant on the yield curve. This theory also admitted to the power of expectation of interest rate, including market participants, to drift from securities of their preferred maturities. For example, even though the commercial banks generally have a requirement of ST funds, short-term asset being their natural habitat may make the investment into medium or long-term assets induced by the expectation of decline in interest rates. Thus, the theory of market segmentation explain and support only a single fact of the yield curve, which is the third fact, that the yield curve is generally upward sloping. This support arises from the observation that the preference for the short holding period creates a demand for the ST securities, leading to an increase in its prices and decline in its interest rates. Other factors impacting interest rates. There exist other factors besides the one discussed in the above theories which have a significant impact on the determination of interest rates. These special factors are default risk, tax considerations, embedded options and liquidity. Default risk, failure of the issuer to honor its interest payment and pay off its face value at the maturity of the bond formulates risk of default for the investors, known as default risk. All the securities except for the ones issued by the government are subject to certain degree of default risk. Such government bonds or securities are known as default-free bonds. Serves as the yardstick for comparing the interest rates to be expected from the bonds with default risk for investing in the risky assets. This difference between the interest rates on bonds with default risk and default-free bonds is referred to as risk premium, being always positive for the bonds with default risk and increases with the rise in default risk. The market expectations of the return drops as the default risk on the securities increases relative to the risk-free securities, ceteris paribus. This leads to decline in the demand for bonds with default risk, leading to the fall in its prices, while the demand for risk-free bonds increases with the decline in its relative riskiness, resulting in the rise in its price. And since the bond price is negatively related with its interest rates, the equilibrium interest rate of the bonds with default risk rises, whereas of the default-free bonds declines with the respective opposite movement in their prices. And this overall assessment of the position of the borrower is done by certain agencies known as investment advisory firms disseminating default risk information through ratings. The investors confers name investment grade security to the securities that have relatively low risk of default and junk bonds to the securities to higher default risk securities. Next, tax considerations. The reduction in demand for non-tax exempted securities reduces its prices in the market, leading to an increase in its equilibrium interest rates. As a result, difference in interest rates of securities with respect to income tax consideration emerges among the securities having similar characteristics. For instance, in USA, though, it is treasury bonds that enjoy the highest liquidity. It is the municipal bonds that offered lower interest rates than treasury bonds for over 4 decades since 1942. Note, lower interest rates are associated with higher liquidity of the asset, enjoying higher demand among the investors. This higher demand for the municipal bonds stems from the tax exemption from federal income taxes permitted by US government on its interest payments, improving its after-tax yield. For example, an investor has to choose between two securities A and B, the features of which are as follows. Security A offers an interest rate of 10% at the face value of $100. The tax rate of 30% applies on the interest income earned from this security. Security B offers an interest rate of 8.5% at the face value of $100. The interest income earned from this security is fully exempted. Solution. In the above example, the after-tax income of the investor is as follows. Security A. The bond will provide before tax yield of $10 on which the tax of 30% shall apply, that is $3, leaving the after tax yield of $7, $10 minus $3 only with the investor. Security B. The before tax yield of $8.5 will be left with the investor. This is the final amount left with the investor without any further deduction as tax is exempted on the capital gains arising from this security. Thus, the investor will obviously choose security B out of two securities as the final yield generated by security B $8.5 is more than that provided by security A $7. Next, embedded options. In comparison to the straightforward coupon payments offered to the investors by simplest securities, there are other securities which provide options of callability or convertibility either to borrower or to lender respectively. Next, callability option. This option is available with the borrower, which could be an individual or a company, enabling them to pay off and refinance original loan before it matures. For example, suppose the market yield of the security drops to 8% from its original yield of 10% issued at a price of $100. The price witnesses a corresponding increase to $140. This decline in the yield incurs a loss for the borrower as he is liable to pay the lender higher interest rate at 10%, whereas the prevailing market yield is at 8%. In such situations, the inclusion of call provision in the loan agreement renders protection to the borrower, but lenders, investors runs the risk of early call on their investments before voluntary desire for their funds, reducing their capital gain from market fluctuations. The borrower can pay off its debt back to its lender and reissue fresh security at a lower cost of prevailing market interest rate. Thus, such provisions necessitate a higher market yield on bonds to induce an investment by the investor compared with the ones without call provision. The ordinary residential mortgage is a typical example of callable security where the borrower has the right to pay off its mortgage at any time without paying penalty. Convertibility option. This option provides protection to the lender's investors whereby they have the right to convert their issued bonds into equities at a predetermined price. On the other hand, the conversion to equity can be exercised if the stocks of company are trading at a higher price, raising its market price. However, the conversion will take place at predetermined lower price and not the market price. Since this provision renders valuable protection to the investors, the yield on convertible bond is lower than normal bonds. Next, liquidity. The liquidity refers to the feature of asset that facilitates quick and cheap conversion into cash at the time of requirement. The higher liquidity of the asset ensures its effective conversion into cash without loss, increasing its desirability and thereby its demand in the market. Other things being equal, the investors earn a lower interest rate or yield on the highly liquid asset as compared to the securities which are illiquid or less liquid. High liquidity assets are so popular among the investors and widely traded that their selling and conversion into cash in emergency leads to no or negligible loss. In contrast, illiquid assets are not as popular and thus are difficult to trade, increasing the hurdles to find the buyers along with escalating transaction losses. Consequently, the liquidity of the asset increases its demand in the market, leading to an increase in the price and thereby decline in the interest rates offered on such security. Similarly, the lesser demand for the illiquid securities reduces its demand in the market, decreasing its price but increasing its interest rate. Let us now summarize. Spot rates, the price or rate of buying or selling a commodity, security or currency for settlement on the spot date is known as the spot price or spot rate. Bond pricing. In simple words, it is the price paid by a person to buy a bond. Alternatively, present value of the expected cash flows of a bond is termed as bond pricing. Yield to maturity. It is defined as the single interest rate at which the market price of a bond is equal to the sum of present value of its coupon and its principal payments. Thank you.